Greece is being treated like a difficult 5-year-old. It was consigned to the naughty step after rejecting austerity and calling a referendum, then told it could go to bed without supper if it didn't start behaving right now. Having copied Violet Elizabeth by promising to squeam and squeam until I make myself thick, Greece then bowed to the will of its elders in the Eurozone. Now, like any sensible parent, Europe's now offering sweeties to reward the good behaviour, in the form of more cash from the European Central Bank and some temporary money from the European Financial Stabilisation Mechanism to tide it over until a proper rescue deal, which was agreed in principle by Eurozone finance ministers today, can actually be finalised. Now, all this sounds like great news, but markets weren't terribly impressed. As you can see, the euro fell a little, that's the red line here, and German shares rose a little, continuing the recent inverse relationship between the two. You can see just how dramatic that's been so far this year. Now, the Greek people shouldn't be all that pleased either. The €900 million extra in emergency lending to Greek banks that was allowed this week amounts to €32 a day for each household. Now, Greeks won't see any of the €7 billion EFSM bridging loan either. The money comes in from the European Commission and goes straight back out again to repay, yes, the ECB and the IMF, the supposed saviours of the country. Now, voters in Europe, but not in the euro, may not be that happy either. Their support for bridge finance is only required so that an ECB bond maturing on Monday can be paid off. If the same thing had happened in the UK, Sweden, Denmark or another member state with its own currency, the problem would never arise because the central bank would just deal with it. And if for some reason the central bank didn't deal with it, you really can't see much chance that the Germans or French would chip in to help. Still, shifting some other cash around might provide some extra security for the non-euro states, potentially reducing the political opposition there. Now, all these sweeties might leave a sour taste in Greek mouths, but the lazy parenting model that Europe's been following was stuck to, with the promise of more treats soon. Of course, all of that's been priced in the very sharp rise that we saw in European shares, and particularly here in German shares, over the last week or so. Now, one of these two treats suggests genuine help in the form of a reduction of Greek debt, but unfortunately for Greek politicians, not in the form of cuts to the face value of debt, something that's toxic in Germany. And Mr. Draghi insisted it was uncontroversial that debt relief is necessary. That's something that will come as news to millions of German voters. But the debate now, he said, was over the form of the relief that's offered on the debt, with the IMF warning that repayments might need delaying by 30 years or more. It's much easier to explain debt reduction if there's a simple cut to the size of the amount that has to be repaid. But putting off the payments for decades can have much the same economic effect without the political pain. Broadly speaking, politicians think that voters don't understand the time value of money. Now, the second treat is that the ECB might start buying Greek bonds at some point. Mr. Draghi highlighted that Cypriot bonds have been included in quantitative easing, which has surely helped drive their prices, which you can see here in red for the 2020 Cyprus bond, surely helped drive those prices up a lot and yields down. There was a time when Greek bonds performed similarly to Cyprus's. You can see over this period here with the 2025 bond there in blue. But at the moment, that definitely isn't the case. While the Cyprus bond's been stable to better, thanks to QE, and of course the improvements in Cyprus, the Greek bond price plunged to the price was in the 30s at its low here before the dramatic rebound that we've seen in the last few days. Now, it's going to be a while before Greece can qualify for QE, even if everything goes swimmingly. But for bondholders, this would be a truly tasty reward.